In 2025, about $957 billion in commercial and multifamily mortgages came due in the United States. So let me ask you a very uncomfortable question. If those loans start cracking, how far away is your local bank from the blast radius? Because this story is not really about glass towers. It is about your paycheck, your savings, your credit line, and the boring little bank branch next to the pharmacy that suddenly matters a lot more than you thought. The commercial real estate doom loop is simple, ugly, and very real. Higher rates hit property values, refinancing gets harder, banks tighten credit, local businesses slow down, vacancies rise, and the same loans get even shakier. This case study represents real financial patterns and real-world data. Meet Luis Ramirez, a representative fictional character built from real numbers. He is 38, works in HVAC, and spends his days fixing air systems in offices that somehow manage to feel empty and over-air-conditioned at the same time. His wife, Maya, works the front desk at a medical clinic. Together, they bring in about $86,000 a year before taxes, which is close to the U.S. median household income of $83,730, and Luis alone earns roughly in line with the 2025 median full-time worker pay of $1,204 a week, or about $62,600 annualized. On paper, they look fine. In real life, fine means the money arrives, waves politely, and leaves immediately. Average U.S. household spending hit $78,535 in 2024, with housing alone averaging $26,266 and transportation another $13,308. More than half of household spending was basically shelter and getting somewhere. National median gross rent was $1,413, and even where people owned, housing costs still ate a huge chunk of the month. Cheap living did not exactly make a comeback tour. Inflation cooled from the 2022 panic, but it did not disappear. Consumer prices rose 2.7% in 2025, while shelter rose 3.2% and food rose 3.1%, which is economist language for your wallet still noticed. And the country was already carrying a mountain of consumer pressure. By the end of 2025, total household debt reached $18.8 trillion, including $1.28 trillion in credit card balances. Luis and Maya were not reckless. They had about $8,400 in savings, around $5,800 on credit cards, one car loan, and a mortgage that felt stable only because they had not looked too hard at everything else. Their local bank had their checking, their emergency fund, their mortgage auto-pay, and most of their trust, which is exactly how local banks like it. Sticky customers, familiar faces, and zero dramatic music. Luis liked that bank because it felt human. Big banks felt like apps with buildings. This place gave out free pens, knew his daughter's name, and approved his first truck loan years ago. But here is what Luis did not understand. A community bank can be wonderful at customer service and still be dangerously concentrated in the wrong kind of loans. Commercial real estate includes construction loans and loans on income-producing property. In plain English, offices, shopping centers, apartment buildings, hotels, warehouses, and the projects that turn dirt into debt. And in this market, office has been the problem child who keeps setting the couch on fire and then asking for another allowance. The FDIC's 2025 risk review said office property values were still down 39% from pre-pandemic levels as of December 2024. Vacancy in the top 20 office markets hit 15.2%. Read that again. A building can still be standing, still have a lobby that smells expensive, still have a security guard and a coffee kiosk, and still be worth dramatically less than it used to be. Why? Because commercial property math is brutally rate sensitive. When financing costs stay high, buyers pay less, owners refinance at worse terms, and once comfortable deals start wheezing. Even by June 2026, the Federal Reserve still had the federal funds target at 3.5 to 3.75%. This was not the ultra-cheap money era anymore, and everyone built on old assumptions could feel it. That is why the maturity wall matters. In 2025 alone, about 24% of office property loans were scheduled to mature, and many owners were praying for lower rates that did not arrive on schedule. Now comes the part that should make every local bank customer sit up straighter. Smaller banks do not always have the worst delinquency rates, but they often have much higher concentration in commercial real estate than giant banks do. The FDIC said community banks held 29% of the industry's CRE loans, while holding only 15% of total industry loans. Median CRE concentration was 195% at community banks, 289% at regional banks, 314% at banks with $1 billion to $10 billion in assets, and only 69% at banks over $100 billion. That does not mean your local bank is doomed. It means if it has the wrong mix of loans in the wrong market at the wrong time, it does not have as much room for error as you probably assumed. And here's the sneaky part. A doom loop does not have to begin with a cinematic bank failure. It can begin with something much more boring and much more personal. Your bank simply becomes stingy. The banking industry actually finished 2025 with strong overall earnings. That is what makes this dangerous to ignore. Stress does not always show up wearing a Halloween costume. Sometimes it shows up as new underwriting standards. Luis first noticed it at work. 2 office clients delayed maintenance. One landlord postponed replacing a dying rooftop unit. Another wanted repairs, but not the invoice this month, apparently. That was the first crack. Empty offices were not just a statistic on television. They were fewer work orders, slower payments, and more awkward phone calls that began with, "Quick question." Then came the second crack. Luis and Maya had planned to use a small home equity line as a backup for a roof repair if needed. Not because they wanted debt, but because middle-class life loves a backup plan almost as much as it loves surprise expenses. The bank did not say no forever. It said not now, not easily, and not on terms that felt friendly anymore. Which, in real life, is how a lot of financial stress actually arrives. At the same time, their credit card interest felt like a mosquito with a law degree. Average credit card APRs were around 19.56%, so carrying a balance was less temporary convenience and more slow voluntary bleeding. Nationally, the personal saving rate was just 4.5% in May 2025. So Luis realized he was not uniquely bad at money. He was living in a country where many households were balancing on a thinner ledge than they admitted. Then he made the mistake most people make right before they get serious. He said, "We'll probably be fine." Probably is a beautiful word when you are picking pizza toppings. It is a terrible word when your emergency plan depends on uninterrupted overtime, easy credit, and one local bank staying comfortable. So Luis stopped treating bank risk like a rumor and started treating it like weather. Not guaranteed disaster, just something stupid to ignore if the sky is already changing color. First, he checked what was actually protected. FDIC insurance covers up to $250,000 per depositor, per ownership category, per FDIC-insured bank, and the FDIC says no depositor has lost a penny of insured funds since 1933. That did not mean he could relax and do nothing. It meant he could stop confusing bank stress with "all my cash disappears" and focus on the risks that actually hit families first: access, credit, timing, and local jobs. Second, he opened a backup account at another institution, not because he was a doomsday prepper, but because one bank for everything is efficient right up until it becomes inconvenient in a very expensive way. Third, he stopped calling available credit an emergency fund. That one hurt. A lot of middle-class households say they have a backup plan, when what they really have is permission to borrow at the worst possible moment. Fourth, he attacked the highest interest debt first. The family threw every extra dollar at the credit card because 19+% interest is not a budget category. It is a financial leak with attitude. Fifth, they rebuilt cash around real monthly expenses. Luis estimated their bare-bones number at about $4,300 a month, so the goal was no longer save whatever. The goal was specific, boring, and effective. He picked up more residential HVAC work on Saturdays. Maya cut 2 convenience subscriptions they barely used. They delayed replacing Luis's truck, canceled the fantasy vacation, and basically told lifestyle creep to wait outside. None of this was glamorous. No one posted, "Just diversified my bank access and reprioritized revolving debt, feeling cute." But financially, it was the first truly adult thing Luis had done in years. Over the next 9 months, the family's emergency savings rose from $8,400 to about $13,200. Their credit card balance fell from $5,800 to around $2,300. Not miraculous, just real. And notice what did not happen. Luis did not become a millionaire. He did not escape the matrix. He did not buy a course from a guy standing next to a rented Lamborghini. What had happened was more important. When local commercial clients got slower, when credit stayed tighter, and when bank headlines started sounding weird again, his household stopped being one surprise away from panic. That is the real transformation in a banking stress cycle. Not profit, not prediction. Resilience, because your local bank can be at risk without your deposits necessarily vanishing. The risk can show up as tighter lending, frozen plans, delayed business activity, falling overtime, weaker local property values, and more households leaning on debt. The FSOC warned that rising vacancies, slower rent growth, and higher borrowing costs were already pressuring borrowers and increasing delinquencies, loan losses, and provisions at banks, especially around office and some multifamily stress. And the FDIC noted that while large banks had more visibly troubled non-owner-occupied CRE loans, smaller banks often had lower diversification and higher concentration, which is a very polite regulatory way of saying they have less room to be wrong. So what should you learn from Luis? First, know where your cash is, what is insured, and whether one institution has become a single point of failure in your life. Second, do not count on easy refinancing, easy HELOC access, or easy business credit in a period when commercial property lenders are already under pressure. Third, if your budget only works when overtime stays high and interest rates stay friendly, your budget does not work. It is just having a good week. Fourth, the most dangerous financial sentence in a fragile economy is, nothing has gone wrong yet. Because by the time something goes obviously wrong, the smart money is usually not panicking. It has already adjusted quietly months earlier while everyone else was still arguing on the internet. Luis learned that local bank risk is not just a banking story. It is a personal finance story disguised as a commercial real estate story, wearing business shoes and pretending it has nothing to do with your kitchen table. So here's the question I want to leave you with. If your local economy got tighter, your bank got stricter, and your credit got more expensive at the same time, would your life bend or would it break?